Hello, and welcome back to Bonnie's Life, the channel where we cut through the noise to give you the insights you need to navigate our complex world. Today, we're tackling a question that's on every investor's mind. Are the markets overvalued? Are we standing on the precipice of a major correction? Or are the high valuations we're seeing justified by a new economic reality? We'll be taking a deep intellectual dive into the stock market, the volatile world of cryptocurrencies, and the often overlooked commodities market. And as always, we'll be looking at the data the mainstream media often ignores, giving you a balanced, fact-based perspective you won't find anywhere else. So, grab a coffee and let's get started. Let's start with the big one, the stock market. For months, we've seen headlines about record highs, but also whispers of a bubble about to burst. So what's the real story? On one hand, you have the bulls, who argue that today's valuations are justified. They point to strong corporate earnings, with many companies reporting record profits. They also highlight the transformative power of technology, particularly artificial intelligence, which they believe will unlock unprecedented levels of productivity and growth. Then there's the Tina argument. There is no alternative. With interest rates still relatively low, the returns on bonds and other safe assets are simply not attractive enough for many investors, pushing them into stocks. But then you have the bears, and they have some compelling arguments. They point to a number of valuation metrics that are flashing red. The trailing 12-month price-to-earnings ratio, or P/E ratio, for the S&P 500 is currently hovering around 28, significantly higher than its historical average of about 16. Even more concerning is the P/E10 ratio, which uses 10 years of earnings to smooth out short-term fluctuations. That number is at a staggering 38.9, a level we've only seen a few times in history, most notably just before the dot-com crash and the 1929 market collapse. Some analysts even suggest the market is overvalued by as much as 197%, depending on the indicator used. These are not numbers to be taken lightly. Now, here's what you might not be hearing on the evening news. A significant portion of the earnings per share growth we've seen has been driven by corporate stock buybacks. When a company buys back its own shares, it reduces the number of shares outstanding, which artificially inflates their earnings per share, even if the company's net income hasn't grown at all. It's a financial engineering trick that can make a company look more profitable than it actually is. Another factor to consider is the rise of passive investing. The massive inflows into ETFs and index funds have created a situation where a rising tide lifts all boats, regardless of their individual fundamentals. This can lead to a misallocation of capital, with overvalued companies becoming even more overvalued. And finally, the market's gains have been heavily concentrated in a handful of mega-cap tech stocks. This lack of breadth is a classic warning sign of an unhealthy market. Let's delve deeper into the stock market's current state. The narrative of a robust economy, fueled by resilient consumer spending and a strong labor market, has been a powerful driver of bullish sentiment. We're constantly reminded of the low unemployment rates and the seemingly insatiable demand for goods and services. This narrative, however, may be masking some underlying weaknesses. For instance, much of the recent consumer spending has been financed by debt, with credit card balances reaching all-time highs. This is not a sustainable source of growth, and as interest rates remain elevated, the cost of servicing that debt will become an increasingly heavy burden for households. Furthermore, while the headline unemployment number may be low, a closer look at the data reveals a more nuanced picture. The labor force participation rate has yet to return to its pre-pandemic levels, and many of the new jobs being created are in low-wage sectors. This suggests that the labor market may not be as strong as the headline numbers suggest. The role of the Federal Reserve in all of this cannot be overstated. The central bank's unprecedented monetary stimulus in the wake of the pandemic created a massive liquidity bubble, which has inflated the prices of all assets, including stocks, while the Fed has since embarked on a tightening cycle, raising interest rates at the fastest pace in decades. The market has so far shrugged off these concerns. The prevailing view seems to be that the Fed will be forced to pivot and start cutting rates at the first sign of economic weakness. This Fed pivot narrative is a dangerous one, as it encourages investors to take on excessive risk in the belief that the central bank will always be there to bail them out. But what if the Fed is serious about taming inflation, even if it means causing a recession? What if the so-called soft landing that everyone is hoping for turns out to be a fantasy? These are the questions that should be keeping investors up at night. Another aspect that is often downplayed by the mainstream media is the geopolitical risk. We are living in an increasingly unstable world with rising tensions between major powers, ongoing conflicts in several regions, and the ever-present threat of terrorism. Any one of these risks could escalate at any moment, sending shockwaves through the global financial system. The war in Ukraine, for example, has already had a major impact on energy and food prices, and a wider conflict could have devastating consequences for the global economy. And similarly, the ongoing rivalry between the United States and China is a major source of uncertainty for investors. The two countries are locked in a struggle for technological and economic dominance, and the risk of a miscalculation or an outright conflict is very real. These geopolitical risks are not being adequately priced in by the market, which seems to be operating under the assumption that the world will continue to be a relatively stable and predictable place. This is a dangerous assumption, and one that could prove to be very costly for investors who are not prepared for the possibility of a major geopolitical shock. Now, let's turn our attention to the Wild West of the financial world. Cryptocurrencies? Is this the future of money, or are we witnessing a modern-day tulip mania? The bulls will tell you that crypto is a revolutionary technology that will fundamentally change the way we think about finance. They see Bitcoin as digital gold, a hedge against inflation and the debasement of fiat currencies by central banks. They point to the growing adoption of crypto by major corporations and financial institutions as evidence that it's here to stay. And they're excited about the potential of blockchain technology and smart contracts to create a more decentralized, transparent, and efficient financial system. But the bears see a very different picture. They see a market driven by pure speculation, with prices that have no connection to any underlying value. They point to the extreme volatility of cryptocurrencies, where it's not uncommon to see prices swing by 20% or more in a single day. They also raise concerns about the environmental impact of crypto mining, which consumes vast amounts of energy. And then there's the regulatory risk. Governments around the world are still trying to figure out how to deal with cryptocurrencies, and the threat of a crackdown is always looming. So, what's the hidden story in the crypto market? One of the biggest risks that's often overlooked is the role of stablecoins. These are cryptocurrencies that are supposedly pegged to a stable asset, like the US dollar. They're the lifeblood of the crypto ecosystem, used to facilitate trading and provide a safe haven from volatility. But there are serious questions about whether stablecoin issuers actually have the reserves to back up their coins. A collapse of a major stablecoin could trigger a systemic crisis in the crypto market. Another dirty secret is the prevalence of wash trading, where traders simultaneously buy and sell the same asset to create the illusion of high trading volume. This can be used to manipulate prices and lure in unsuspecting investors. And finally, the crypto market is heavily influenced by a small number of whales, individuals or entities that hold large amounts of a particular cryptocurrency. These whales can move the market with a single trade, making it a very dangerous place for the average investor. Let's dig deeper into the crypto conundrum. The narrative of decentralization and freedom from government control is a powerful one, and it has attracted a loyal following of believers. But the reality is that the crypto market is becoming increasingly centralized. A small number of large exchanges and mining pools now control a significant portion of the market, which gives them a great deal of power and influence. This concentration of power is a direct contradiction of the decentralized ethos that crypto was founded on, and it raises serious questions about the long-term viability of the project. Furthermore, the anonymity that was once a hallmark of cryptocurrencies is rapidly disappearing. Governments are cracking down on illicit activities, and they are using sophisticated surveillance tools to track transactions on the blockchain. This means that the idea of crypto as a tool for financial privacy is becoming less and less of a reality. The recent boom in non-fungible tokens, or NFTs, is another area of concern. While the technology behind NFTs has some interesting potential applications, the market has been flooded with a wave of speculative frenzy. We've seen digital images of rocks and cartoon apes selling for millions of dollars, and it's hard to see how this can be sustainable. The NFT market is a classic example of a bubble, and when it bursts, a lot of people are going to get hurt. The same can be said for many of the so-called altcoins that have flooded the market. While some of these projects may have legitimate use cases, the vast majority are little more than get-rich-quick schemes. They are promoted with slick marketing campaigns and promises of astronomical returns, but they have no real substance. These are the dark corners of the crypto market that the mainstream media often ignores, and it's where the biggest risks lie. Finally, let's talk about commodities, the raw materials that are the building blocks of our economy. For years, commodities have been out of favor with investors, but that's starting to change. The bulls see commodities as a great hedge against inflation. As the cost of living rises, so does the price of raw materials. They also point to the growing demand from emerging economies, which are industrializing and urbanizing at a rapid pace. And with supply chains still recovering from the pandemic, we're seeing shortages of many key commodities, which is pushing prices higher. But the bears argue that the commodities boom is already running out of steam. They're concerned about the possibility of a global recession, which would crush demand for raw materials. They also point to the long-term trend of decarbonization. As the world transitions to renewable energy, the demand for fossil fuels is likely to decline, and a strengthening US dollar can also be a headwind for commodities, as it makes them more expensive for buyers using other currencies. And the hidden story in the commodities market? Financial speculation plays a much bigger role in driving prices than most people realize. Large hedge funds and other institutional investors can make huge bets on the future price of commodities, which can create a disconnect between the price and the underlying fundamentals of supply and demand. Geopolitics is another major factor. The supply of many key commodities is concentrated in a small number of countries, which can make them vulnerable to political instability and conflict. And finally, we can't ignore the impact of climate change. Extreme weather events like droughts and floods are becoming more frequent and severe, which is having a major impact on agricultural commodity production. Let's explore the commodities market in greater detail. The narrative of a new commodities supercycle, driven by the green energy transition and the rebuilding of global infrastructure, is a compelling one. The transition to a low-carbon economy will require vast amounts of copper, lithium, cobalt, and other key metals. This has led to a surge in investment in the mining sector, and many analysts are predicting a long-term bull market for these commodities. However, there are a number of challenges that could derail this narrative. For one, the mining industry is notoriously cyclical, and it has a long history of boom and bust. The high prices we're seeing today are likely to incentivize new production, which could eventually lead to a glut of supply. Furthermore, the environmental and social impacts of mining are coming under increasing scrutiny. It's becoming more and more difficult to get new mines permitted and built, which could constrain supply and keep prices high. But it could also lead to a backlash against the industry, which could hurt investor sentiment. The energy market is another area of intense debate. The war in Ukraine has highlighted the world's dependence on fossil fuels, and it has led to a surge in the price of oil and natural gas. This has been a boon for energy producers, but it has been a major headwind for the global economy. The long-term outlook for fossil fuels is highly uncertain. On the one hand, the world is committed to transitioning to renewable energy, which will eventually reduce the demand for oil and gas. On the other hand, the transition is likely to be a long and messy process, and we will still need fossil fuels for many years to come. This creates a great deal of uncertainty for investors, and it's one of the reasons why the energy market is so volatile. So, are the markets overvalued? As you can see, there's no easy answer. There are compelling arguments on both sides of the debate, and the truth is likely somewhere in the middle. The stock market is certainly expensive by historical standards, but that doesn't mean a crash is imminent. The crypto market is a hotbed of speculation, but it's also a source of incredible innovation. And the commodities market is caught between the cross-currents of inflation, recession fears, and the green energy transition. What's clear is that we're living in a time of great uncertainty. The old rules of investing may no longer apply, and it's more important than ever to do your own research, think critically, and make informed decisions. Thanks for joining me on Bonnie's Life. Don't forget to like, subscribe, and let me know what you think in the comments below. I'll see you next.